Gurpreet, good to see you. So here we are then, a 0.25% increase from the Bank of England. Were we expecting this?
Yeah, so the headline figure is 5.25%. It's a 0.25 percentage point increase from the Bank of England today. It was widely expected from economists. So most economists were penciling in this increase. There were no major shocks. It now marks the 14th consecutive interest rate rise since December 2021, when the bank first started raising interest rates from a record low of 0.1%.
So what's been the reaction? Because Labour will say, actually, it was the Conservative government that, I suppose, accelerated with their mini budget the hard times that people are experiencing now.
Yeah, I mean, there are a lot of causes of inflation that all interact. The major one, and the kind of the biggest issue that we had to start with, was imported inflation. So it was the energy crisis, it was the war in Ukraine that triggered a massive spike in gas prices. And we're really vulnerable to that in the UK because we use a lot of gas to heat our homes. We've also had a huge increase in food price inflation. We've had supply chain bottlenecks all over the world that have affected our food supply. Brexit has played a part in it, and the effect that it's had on the value of the pound. So that's one side of it. But then, I know I'm getting really into what's causing inflation, but then there are also other issues at play. In Britain, we have a really tight labour market at the moment. During the pandemic, lots of people left the world of work. And when our labour market shrinks in the way it has, that puts lots of pressure on wages. And when wages are rising in the economy, that can fuel inflation even higher. It's something the Bank of England is keeping a really close eye on. So a lot of different things involved here, all fueling inflation in the economy.
It's a big juggling act, isn't it? And is there any optimism that people can hold on to?
Yes. And I'll start a month ago. Because a month ago, it looked like interest rates were going to peak at above 6%. And then we had the inflation data. And the inflation data showed us that inflation is actually falling faster than we expected. So it came in at 7.9%. Now, that's still almost 4 times the Bank of England's 2% target. It isn't a massive reduction, but it showed that the inflationary trend was moving in the right direction. And so before today's announcement, some thought that the bank might have to raise interest rates by 0.5 percentage point to 5.5%. But that good news on inflation means that it's only had to raise rates to 5.25%. And the peak, so the peak where we expect interest rates to end up before they start coming down, has also come down to below sort of 5.7% now. So as I said earlier, before all of this, we were expecting a peak of above 6%. Now, what is really interesting that's come out of the Bank of England's report today is that although the peak where interest rates may end up, according to the markets, has come down, the bank has really strongly hinted that rates are going to have to stay higher for longer. So if you're a mortgage holder and you thought you might be able to ride out the next year and a half and then you could start benefiting from falling interest rates, well, it's not going to be as straightforward as that. We're getting used to a new normal of high interest rates. It looks like interest rates could be 5 or above 5% for a few years at least.
What are the government saying at the moment? Because it's one of Rishi Sunak's pledges, isn't it, to get inflation down. He's on track to do that then?
Yeah, so this is where it gets a little bit interesting, because the government has set itself a target to halve inflation by the end of the year. So they're saying, judge us on whether inflation is half the level it was at the start of the year. And that's about 5.4% is the rate it needs to meet. The bank today said the government's going to meet that. So inflation will end the year at 4.9%. The Treasury will be celebrating that. The Prime Minister will be celebrating that. However, there's a more important target, and the more important target is actually the Bank of England's 2% target.
Yeah.
So although the headline rate of inflation will be halved by the end of the year and the Chancellor will meet his aim, actually to get back to 2% is now going to take longer than we thought before today. So prior to today, we thought we'd be hitting the 2% target by the first quarter of 2025. It now looks like we're going to be hitting that in the second quarter of 2025. That could also explain why interest rates are going to stay higher for longer as well.
So that's a headache for people with mortgages, people who are renting, who we've found out since that Sky News reveals that actually renters are the most exposed group when it comes to interest rates, and savers also. You know, this would have been a really good time for them to get a bit more back on their money, it's not necessarily happening as fast as it should.
Yeah. So interest rates work in two ways. So when the Bank of England raises interest rates, it's trying to dampen demand in the economy. It doesn't want people to go out spending. It wants them to stop so that prices come down. Now, there are two kind of main transmission mechanisms for this. There's the borrower side and the saver side. On the borrower side, you hike up people's mortgages. They don't have as much money to spend on other things, so that reduces demand in the economy. On the savings side, if you hike up the savings rate, which higher interest rates should also translate into higher savings rates, then people are more incentivized to keep money in the bank account instead of going out to spend it. Now, the problem is the banks aren't passing on higher interest rates to savers like they are to mortgage holders. They have been passing them on. They are doing better, but they're not passing them on nearly as quickly enough as they are passing them on to mortgage holders. And you can see that reflected in the kind of profits that banks are making. And there's a lot of pressure now from MPs and from the government on banks to do better on this and to give savers a fair deal.
So what are people saying about how the Bank of England have been handling this? Because it does feel like a bit of a gamble here, because there are some voices that say this could potentially tip the UK into recession. That's a worry too.
Yeah, it's really, really difficult to make the right judgment because it's a balancing act. And I think this is a really good reminder of how economics and monetary policy, it's not a science. It's, based on judgments. It's very much an art. And that was really illustrated in the vote by the members of the Monetary Policy Committee when they were deciding what to do with interest rates.
And what's their role in this? Because they were split a bit, weren't they?
Yeah, exactly. So the Monetary Policy Committee, it's 9 economists. They sit on the Monetary Policy Committee. They vote on what we should do with interest rates. So this decision today was based on the votes that they cast. And the vote was split. It was 8-1. So 8 members voted to raise rates. 1 member voted to leave rates unchanged. But actually, there's a bigger divergence of opinion than that headline suggests, because within the 8 that voted to raise rates, 2 voted to raise them by 0.5%, and actually we got them to 0.25%.
Oh my goodness.
So actually what that's showing us is that there's a huge divergence in opinion about what the best course of monetary policy is right now. And part of the reason it's so difficult is because although we've raised interest rates pretty aggressively since the end of 2021, we haven't actually seen the full impact of it yet. It can take up to 18 months for us to really see the impact.